Look at the balance in your bank account. Most of that money was never printed. No machine ever stamped it. It was typed into existence, out of nothing, by a bank. Here's the part that sounds impossible. About 95% of all the dollars in the economy were not made by the government. They were created by ordinary banks with a keystroke the moment somebody took out a loan. Not printed, not minted, just typed. So where does that money come from? And if a bank can make it from nothing, why are you the one working so hard to get it? Let me show you exactly how this works. First, the story we were all told. It goes like this. A bank is a piggy bank. Savers put their money in. The bank keeps it safe, then lends that same money out to borrowers and takes a small cut in the middle. A careful little go-between. Just moving money from people who have it to people who need it. It's simple. It's tidy. And it's almost completely wrong. Banks are not waiting for your savings before they can lend. It's the other way around. The loan comes first, and the money is born at the moment the loan is made. Let me show you with one person and one number. You walk into a bank for a $200,000 mortgage. In the piggy bank story, the bank now goes and finds some saver's $200,000 sitting in a vault and hands it to you. That is not what happens. What actually happens is this. The bank approves your loan, opens your account, and types $200,000 into it. That's it. That money did not come from a saver. It did not come from a vault. It did not exist 1 second earlier. The bank created it on the spot by writing a number. Think of a bank less like a vault and more like a scorekeeper at a game. The scorekeeper doesn't need a box of points in the back to add 10 to your score. They just write a bigger number. The points are real. They count. You can use them. But they were never sitting in storage. They were created by the act of writing them down. Your money works the same way. When the bank lends you $200,000, it writes 2 numbers in its ledger. On one side, your new deposit, money you can spend. On the other side, your loan, money you owe. The two are created together in the same instant, from nothing. And here's the strange, beautiful, slightly unsettling truth. When you finally pay that loan back, that money doesn't go into a saver's pocket. It disappears. The number is erased. The money is uncreated, destroyed, as quietly as it was made. So banks don't lend money. Banks create money when they lend and delete it when they're repaid. Almost every dollar you've ever held started life as somebody's loan. Now, if banks can make money from nothing, you'd think they'd be the most relaxed businesses on earth. Here's what most people never stop to ask. If it's free to create, where's the catch? The catch is interest. The bank creates the $200,000 with a keystroke, but it doesn't ask for $200,000 back. It asks for the $200,000 plus interest. Often over 30 years, more than double. Sit with that. The money for your loan was conjured out of nothing. The money to pay the interest on top was not. It was never created. So where do you get it? You earn it. With real hours, real work, real years of your life. You hand back real labor in exchange for numbers that were typed into a screen. And it goes deeper. Because the interest is never created along with the loans, the whole system always owes a little more than exists. The only way to find the money for yesterday's interest is for someone somewhere to take out tomorrow's loan. More debt, more money created, round and round. This is not a secret cabal in a dark room. It's just the design, and once you see it, you can't unsee it. So who pays for all this new money appearing? Quietly, you do. Even if you never take a loan. Every time banks create a fresh wave of money, there are more dollars chasing the same amount of real stuff. The same houses, the same groceries, the same gas. And more dollars chasing the same things means each dollar buys a little less. You know this by its everyday name. Prices going up. Inflation. Here's the sting. The dollars you've already earned. The ones sitting in your checking account. The ones you were told to keep safe. Those get watered down too. You didn't spend them. You didn't lose them. They just quietly buy less every year because new money keeps getting made around them. So, the people holding idle cash slowly get poorer, doing nothing wrong. And the people who borrowed to own real things, a house, a business, a slice of the market, tend to come out ahead. The system rewards being on the right side of created money, and quietly taxes being on the wrong side. So, what do you actually do with this? Here's the one rule that falls out of all of it. If money is constantly being created, then cash sitting still is a slowly melting ice cube. The job is not to hold the ice cube. The job is to hold things that rise as the tide of money rises. A rough number to remember. The supply of money tends to grow somewhere around 5 to 7% a year. That's your finish line. If the money you're holding isn't growing at least that fast, you're not standing still. You're quietly going backward. That doesn't mean do anything wild. It means don't be the person holding only the melting cash and the high-interest debt. Be the person who owns a piece of something real that floats up with the rising water. Let's make it personal, because this isn't abstract. It's in your accounts right now. Take a $300,000 mortgage at around 6.5% over 30 years. You'll pay back roughly $680,000, more than double. The house cost $300,000. The interest on money typed into being cost you another $380,000. That's years of your working life, handed over for numbers in a ledger. Now flip to the other side. Say you keep $10,000 in checking because it feels responsible. Over 10 years, with normal inflation, that $10,000 quietly loses $2,000 to $3,000 of its buying power. Same number on the screen, much smaller life behind it. And the younger you are, the longer this runs in the background, for you or against you. Decades of created money will either lift the assets you own or shrink the cash you cling to. You're not going to overthrow the banking system this week, but you can stop standing on the wrong side of it. One move. This week, look at two numbers. How much money you're holding as idle cash, and how much high-interest debt you're carrying. Credit cards, anything in the high teens or 20s. Then take one step. If you're drowning in high-interest debt, killing it is the best investment you'll ever make. Paying off a 20% credit card is a guaranteed 20% return, risk-free, and it stops the interest machine cold. And if you're sitting on a pile of cash doing nothing, move a sensible slice of it into something that owns a piece of the real economy. A simple, broad, low-cost index fund. So your money rides the wave instead of melting under it. You don't have to beat the system. You just have to stop volunteering to lose to it. So, here's the truth plain. Money isn't a thing the government quietly prints and hands out. It's mostly numbers, created by banks the instant we borrow, erased the instant we repay, and rented to us, at interest, for a slice of our lives. The money was made from nothing. The work to pay it back is very real. Knowing which side of that you're standing on changes everything. Next time, I'll show you the quiet thief that all of this sets loose. How inflation steals from you a little every single year. The tax nobody ever votes for. Until then, don't hold the melting ice cube.